What's going on, everybody? Welcome back to Know Before You Owe. Brian Parker and the Brian Parker Group. We're going to start today's video with something a little different. I think I'm going to start throwing these in so maybe you stay more in tune and have a little fun at the same time. So every now and then I'm going to put a trivia question out there, and the first person to answer it right back in the replies, I'll follow back up with you, and I'll get you a $20 Starbucks gift card. Send it right out to you. So today's question and trivia question for you is, what program used to finish off, keep your feet on the ground and keep reaching for the stars, and who said it? Okay. What program would finish off each episode by keeping your feet on the ground and keep reaching for the stars, and who was the person that said it? All right. So let's get into today's video. We're going to talk about different types of property and how your financing looks for each one of them. So when you're talking about residential financing, you're talking from 1 unit up to 4 units. Anything over 4 units becomes a commercial loan, okay? So if you're looking at buying a home, a duplex, triplex, or a quadruplex, that is residential financing. So single family home, that is really not the title for every home that's out there. A single family home can be a brick ranch style home, a 2-story home, stick built home, all of that. It can be a townhome. Those are really your classifications of a single family home. Now, you also have modular homes, which a modular home looks like a regular single family home, but the classification is a little bit differently, and that may or may not affect your financing. And you have off-frame modulars and on-frame modular homes. Now, an on-frame modular home is brought in kind of like a double wide. You see them driving down the road, right? It's 2 halves brought in like that. They put it together and complete the house that way. That is an on-frame modular. And in most cases, that's eligible for the same financing as a regular single-family home. An off-frame modular is more like a puzzle. It's actually built in a warehouse somewhere in different sections. They bring it in on a couple of trucks. Take some cranes, they put it together, put the floor system together, put the walls together, the roof and all that. And they build it like a regular single family home. But it's considered an off-frame modular. And that will qualify as the same financing as if you had a regular piece by piece stick built home and doing that regards. Now, you also have manufactured housing, okay? And manufactured housing is your single wide and your double wide. Okay, and that's where they're manufactured off-site. They're brought in, single wide's kind of brought in the way it is. It's set down, put together to finish it off, and same thing with a double wide. The financing on those, your interest rate will be a little bit different and a little bit higher on those property types than the other ones we were previously talking about, okay? Some loan programs will be eligible for those properties, but some of those properties will not be eligible for other types of loan programs. So that's where you want to make sure when you're talking with your mortgage loan officer that you're talking about in your pre-approval process, what type of property are you looking at, okay? Now, the other one we talk about is condominiums. And on our side, when you say condo, in many cases, we say condo. And that's kind of a joking term, but let me tell you why. Condominiums have 2 different types of classifications. One is considered warrantable, which means really no issues, okay? And then the other one is non-warrantable, meaning you may or may not be able to get financing on that type of home. So warrantable means it's probably going to qualify like a regular single family home. That means if you've got 100 units in the apartment complex, certain factors apply to make it warrantable. That there's no more than 50 of those units that are investor type property, mean owned by investors and set up for rentals. That the HOA budget has a certain amount of liquid assets, okay, in its reserves. And then the HOA and the master insurance policy covers enough that it's supposed to cover for all the dwellings and coverages. If all three of those get the thumbs up, that is typically a warrantable condominium, regular for standard financing, okay? Now, if any of those factors don't meet up, or if they also maybe have a high delinquency in HOA dues, it's going to be considered non-warrantable. Now, how is that different for you? Can it still get financing? It sure can. But where many condominiums that are warrantable can get 5% down, 10% down, kind of standard financing, on a non-warrantable condo, you're probably not going to find financing without at least 20% down. And really, you want to be able to put at least 25% down for a non-warrantable condominium. And why is that? Because when you as the buyer put 25% down, then us as the mortgage lender, we get to do what's called a limited project review on the whole complex instead of doing a full project review. That means we don't have to look at everything we were just talking about that might make it a warrantable condominium, and we can ignore a few things that might go into it. This is very important when you're doing your pre-approval and talking with your mortgage lender and like, what type of property are you going to be looking at to purchase when you go write a contract on your home? So we think about all the things that we got to talk about our loan officer about. My pre-approval, what do I make? What can I qualify for? But your property type makes a big difference in that too if you're not, telling your loan officer about that up front. Anyway, if you have any questions about that, reach out to me, Brian Parker at the Brian Parker Group. Talk with your local mortgage professional. And as always, keep your feet on the ground and keep reaching for the stars. God bless you. Have a great day.